Good afternoon and welcome to our webinar series, Reducing Risk Through Structured Investments. I'd like to mention a couple upcoming chapter events. Our D&I happy hour and networking social on July 20th from 5:30 to 7:30. A webinar series on life settlements for fiduciary advisors on August 15th from 12 to 1. And a webinar series on behavioral approach to economic analysis on August 23rd from 12 to 1. Check our website for details and register today. We are joined today by Josh Lewis, Head of Structured Products, Barnabas Capital, Todd Harris, Director on the broker-dealer RIA Structured Product Distribution team at Barclays, and Jeremy Marquez, SVP Sales, Barnabas Capital. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And we can also take questions of a more interactive nature by raising your hands and allowing you to talk. So just hit that control. And with that, I'll turn it over to Jeremy to begin.
Awesome. Kathy, thank you so much for the introduction. And thanks you all for joining us today. We hope that the information we're going to share with you is valuable. And just to kind of get things kicked off, I'd like to just share with you the agenda, what we're going to be going going through with you today. So I'm gonna kick things off. We're going to talk a little bit about Barnabas Capital and what we do at Barnabas Capital. And then Todd Harris and Josh Lewis are going to talk a little bit about really the market evolution of structured notes, the size of the global and US marketplace, and how these products are actually manufactured. And then I'm going to go into how these products work and maybe how they're positioned in portfolios, and we'll be taking some questions as well. So just a little bit about Barnabas Capital. My guess is many of you probably have not heard of Barnabas Capital, and I'm not surprised to hear that when I do. We're a fairly small distribution company based out of Charlotte, North Carolina, actually Cornelius, North Carolina to be precise. And what we do is we focus on protected growth strategies. So right now you're looking at our website. It says it right there, helping advisors explore protected growth strategies. And really, when it comes to investing, bottom line, you can choose to invest with protection and you can choose to protect with no protection, right? And both can make sense, but the products that we focus on they're protection products. So as I scroll down here, the solutions that we focus on at Barnabas Capital are really threefold. On the left, you see structured annuities. It's a big part of what we do. It's not really what we're here to talk about today, but in the broker-dealer community, the type of annuity that we focus exclusively on is the RILA, the Registered Index-Linked Annuity. We work with 7 different carriers in that space in terms of distribution into the BD community. So names like Bright House and Athene and Allianz, Lincoln, just to name a few, we partner with those carriers to bring those products into the broker-dealer community. We also do some variable life and LTC. And then finally, a big focus of what we do at Barnabas Capital is structured products and structured notes. And that's really what we're going to be focusing on today. So that's what we do. I'm the local wholesaler for Barnabas Capital. So if you live in Georgia, Alabama, or Tennessee, and you're working on these products, I'm the local contact for this. I live up in Cumming, Georgia. So I'm your local guy. At this point, I did want to kick it over to Todd. Todd is joining us today from Barclays, and Barclays is one of our best partners in the notes business. We do a lot of business with Barclays. They've been doing this business for many years. Todd is actually the Director of Structured Products and Distribution, and he's going to talk to us today about the evolution of this marketplace and really the size of the market. So Todd, if you wouldn't mind hopping on, I'll kick it over to you.
No, thanks, Jeremy. Thanks for having me as well. I'm happy to be here. I'm hopeful that everyone on this call has heard of Barclays before. So I'll start there. Just a quick background. I mean, Barclays is an investment bank. We've been in business for over 300 plus years. We operate in over 40 countries, and employ over 80,000 people. So we operate in 2 home offices, actually, one in London and then one here in the US. So I actually sit in New York, right in the middle of Times Square, at the old Lehman building. So I would span my camera around, but it's not that pretty. I think they only just ripped out the green carpets and put in blue. So, but I've been here for 15 years, which has pretty much been my entire career. I joined the bank in 2007 to be exact, and I know that this is an introductory call, so I'm going to kind of go back to the beginning of evolution of structured products. So I won't take time, but I do think it's an important story to tell on kind of how we got to this point in time. When I joined in 07, structured products had probably been around for a couple of years. Not all of the banks were doing them at the time. Barclays, I think, jumped into the pool in about 2005. And nobody really knew about the products, right? I would say that the product started with a product called the reverse convertible. It was actually a product that put a lot of principal at risk. It had some good potential, but at the same time, it was pretty risky. And that has certainly changed with the financial crisis of 07, 08. A lot of products, investors actually ended up losing money. And I think the market kind of looked at itself as, is this really a suitable product for retail? And at that point in time, it really wasn't. It was a complex product that people really didn't understand. So it lost a lot of eyes after the crisis. The market started to pick up again shortly after with market-linked CDs. It's just a different type of a wrapper. A market-linked CD offers full principal protection. It offers you your FDIC insurance, and the market itself. The market at the time really didn't accept that product, and that's kind of when I joined the team here. And I know a bit of a background. There's about 12 people here at Barclays that focus on structured product distribution into the US. 6 of us are focused on the RIA/broker-dealer channel. So that's where I sit. That's where I interact with Jeremy and Josh and some partners alike. And then the other half of the team is focused on placing structured products into private banks. So like your UBSs and your JP Morgans of the world. So market-linked CDs certainly took off, but the market itself, talking how large it is, the market share, there was really, it hovered around $50 billion of notional was getting placed in the US during that time. And it really hovered there for quite some time and never really kind of had that breakout moment until about 5 years ago when that $50 billion market moved to $100 billion. I'd say over the last two years, it's hit 100 billion. This year, I think we're trending toward 110 billion. And why did that happen, right? I think it happened with a combination of a lot of things. One, I think the product has certainly evolved. Of those certainly riskier products have been weeded out, where now issuers like myself and my competitors, offer products that make sense to the retail community. I know Josh is going to talk a little bit about platforms. There's some education platforms that have evolved over the last 2 or 3 years as well that really offer education into this product. They kind of operate under 3 different pillars. Pillar 1 would be your education piece. So as a financial advisor, you could sign on to a platform, you could watch a video that you could even share with an end client that's going to give you insight as to like what exactly you're selling to your client. I know Jeremy touched upon it before, but it's really, we're selling protection, right? It's that simple. The beauty of this product is you can offer very little protection and have a greater opportunity for upside participation, or you can offer deep protection, and gain a little bit of upside participation. We'll get into further on in this call, but that's the beauty of the product. It can be kind of manufactured in any type of way for any type of client and in any type of risk environment. I will, so Barclays in general, I'm one of a couple different partners that Jeremy and Josh work with. So I'm thankful for that they asked me to join. Hopefully we do have some questions later on that we can certainly answer. I hope this is an interactive session. I think that definitely makes the conversation a little bit better. So I encourage people to kind of raise their hand, and we can go a little bit further. I'll pause there for now. Kick it over to Josh if he wanted to add some insight, and then further on, I do want to talk a little bit further about kind of how we manufacture these products. But I think we do that after kind of Jeremy shows you the products that are out in the market. Pause there.
Sure. Thanks, Todd. My name's Josh Lewis. Started in the business about the same time as Todd. We've known each other for a long time, except I was on the buy side at LPL Financial, trading bonds there for around 14 years, saw the same evolution. Now these products have evolved into something, instead of being something more risky for, basically qualified institutional buyers, they become a way of reducing risk and way to increase leverage or income in a portfolio while taking some of that risk off the table for the most part. But they are very, very convenient. You can structure them any way you want. And they're the type of product you can only get through a bank's balance sheet. So people like Todd are able to use the bank's balance sheet to create options that you can't just buy over the counter. So you can't just go out and recreate something like this in a brokerage account. It's something that's unique to the banks, that they can create these options, and you can buy them through a structured note that you couldn't get anywhere else. The most basic structure would be protected growth, which just means you might buy something linked to whatever it is you want. But let's just say the S&P over 5 years, and you get as much leverage on the upside as you can. So let's say 115% upside on leverage. And then on the downside, you might have a 20% buffer. And all that means is that you're leveraged on the upside, you're buffered on the downside, which just means the first 20% of the downside is protected. So at the end of 5 years, if the S&P is down 25%, you'd be only down 5% because that 20% buffer. But that's just a basic structure. So it's just a way of, I'm going to be in the market this amount of time. Let's get some upside leverage and some downside protection. The other way you can use these is income. You can use these to take some risk, just like you would a normal, if you're going to buy stocks or you're going to buy your equity exposure, but you're going to use that equity exposure to get income instead of just growth. And I think Jeremy's going to go through a few examples of these here in just a moment. But the basic structure would be, if I have a client's portfolio, I want to take some risk off the table. I know they're going to be in the market for a little while. Put a portion of your client's equity exposure into a structured note, and now you're just taking risk off the table and increasing upside leverage. So there's nothing you can do that's going to underperform the market. Or if I have a client who needs some income, they have equity exposure, or they need equity exposure, what they really need is income, then we can use that equity exposure to get increased income, then more than you could in just buying, a normal bond or income investment. And I'll turn it over to Jeremy to give you a few examples of each.
Thanks, Josh. That's a great segue. I'm going to share my screen here to put a visual up behind what I'll be discussing here. So really, as we get into some of what these notes actually look like, I think it's important for everyone to remember that at the end of the day, what we're trying to do here is reduce risk in the portfolio, right? But how can we reduce risk without completely crippling upside potential, or also reduce risk while bringing significant levels of yield into the portfolio, right? So we're not trying to increase risk here. We're trying to reduce it and still maintain high levels of income and high growth opportunities. So that kind of just hit on that. There's really two basic types of structured notes in a very broad sense. Notes designed either to capture growth in the market, oftentimes with leverage, or notes that are designed to bring yield or income into a portfolio. Now, this is very broad. There's a lot of different iterations of these two broad categories, but really it boils down to these two. And so that's what we're going to look at today. Under the growth category, think about a risk spectrum, right? On the far end of the spectrum, you've got products that have really little or no market risk associated with them whatsoever. These are fully protected on the downside. And then you start to move up the risk spectrum, and rather than being fully protected, there's still protection in place, but there is some principal at risk. We'll talk about both of those. So let's kick it off with the real low risk type of notes. These are referred to as PPNs, or principal protected notes. And what's common about all PPNs is that they offer 100% downside protection, right? So let's take a look at this particular note. And the purpose of going through these is not necessarily to highlight, one note that we think is great for you and for your client. Really, the point of what we're going through right now is just to bring some context and show you a visual behind what we've been talking about so far. So, all notes are going to have some basic components to them, right? You're going to have an underlier. An underlier is, what is this note based on, right? The performance has to be based on something. What is that? It's called the underlier. All notes also will have a term, right? So it's also referred to as a tenor. And this is how long the note is designed to be held for. And then each note is going to have a level of protection, and then it's going to have the upside potential, right? So let's look at this note. This is a Barclays note. It's linked to the S&P 500, so SPX. It's a 3-year note. So the client, when buying this, should understand that it's buy and hold for 3 years for the most part. There could be some exceptions to that, but that, as a general rule, when you're buying a 3-year note, it should be understood that it's buy and hold for 3 years. Full issuer protection, right? So Barclays is going to ensure that it doesn't matter how far down the S&P may go over the 3-year period. The max loss is 0%. This note is fully protected against losses in the S&P. On the upside, the client is going to get 100% of the growth of the S&P 500 up to a maximum or a cap. And in this case, this particular note has a cap of 29%, right? So when you think about how you would implement this in a portfolio, for clients that have maybe overexposure to the S&P 500 or domestic equities, this would be a way to reduce risk in that portfolio without giving up exposure to equities, right? So this is an example of a PPN. Now, I didn't put an example up, but there's another type of protected note called a market link CD. It works just like a PPN in the sense that you have 100% protection, but there's an additional layer of protection through FDIC insurance. So those are also available. I didn't have one to share with you today. They work, again, exactly the same way. Typically, the terms or the upside are going to be slightly less favorable because of that additional level of protection, right? Those are market link CDs. So next, I'm going to show you another PPN. And this one, similar concept. Let's kind of break it down piece by piece here. The underlier is a proprietary index created by Barclays called Trailblazers 5. And we're not going to get too deep into that, but this is a low volatility index. Doesn't produce home run returns. It just doesn't. When I look at the performance of this index historically, it's like 4.5% a year on average. It's 2 years, 100% protection. But where it gets interesting is not only is there no cap on it, but you get 3.25 times leverage on that performance, right? So if over the 2-year period, if this index had increased by 10%, you would simply multiply 10 by 3.25, and the client would be up north of 30% in that example while taking zero risk. So this is an example of how to get leveraged growth on an equity portfolio while taking zero risk whatsoever. So this is an example of a PPN. Now, moving up the
Hey,
risk.
real quickly, Jeremy,
Yeah, go ahead.
do want to add one thing before you move on from that.
Sure.
These are principal protected notes. So those are corporate bonds issued by Barclays. So rather than just paying a fixed coupon for 2 years, Barclays is going to give you equity exposure with 100% downside protection. Now, that's senior unsecured debt issued by the world's largest banks, in this case, Barclays. Now, there are caveats to that. One being you need to hold to maturity. If this is a 2-year note, you need to hold it at the end of 2 years, then you get 325% of whatever that index did, uncapped, and you get your money back. In the meantime, if you had to sell it out, it's number one, no guarantee you could sell it. Probably could, but there's no guarantee you could, and you'd be subject to market forces. So all these things that occur at maturity, these are buy and hold products. The other thing is it's senior unsecured debt issued by the bank. So it is fully principal protected, backed by Barclays, full faith and credit of Barclays. So there is some credit risk associated with it as well. But that's the two main risks. Just you need to hold at maturity, and it is backed by a bank. So as long as that bank is fine, then you're good to go. And even if it's not, it's senior debt. But there are just a couple of extra risks that I wanted to account for before we moved on.
That's good. Thanks, Josh.
And Jeremy, I can jump into on
Sure.
kind of
Yeah,
the
go ahead, Todd.
high level manufacturing of the principal protected note now. So this, as Josh had mentioned, these are, the issuers are doing the work for you, right? What we're taking is basically a corporate bond packaged with an option, or packaging it together and offering it out in the form of a structured product. So that's the beauty of it. Why would terms differ from one issuer to the next? And it goes back to just a fixed income product, a Barclays benchmark deal that's out in the market versus a JP Morgan benchmark deal. These are issued from our Treasury department, and our Treasury provides levels at the beginning of each month. And that really gives the structured product desks the ability to manufacture these products, right? And where levels would differ gets back to what Josh had mentioned, is like the credit worthiness of the issuers or credit rating. So Barclays Bank PLC is our issuing entity. At S&P we're rated A+, at Moody's we're A1. Now you would expect someone with a lower credit rating to be able to offer more aggressive terms in a structured product, simply because you're taking on more credit risk. And I think that's the simplest way to look at it. I know this is an introductory call, and we should keep everything high level, but like Josh said, it's simply a corporate bond packaged with an option, put together for you and sold as a structured product. I'll pause there.
Thanks, Todd. No, that's great. Appreciate that. Cool. So let's kind of continue moving up the so-called risk spectrum here and look at more traditional growth type of notes, which do put the principal at risk, but with still some downside protection. So a couple of notes here that we're going to look at. First one, this is linked again to S&P 500. This particular note, it's very simple. It's a fixed period of time for 4 years and 9 months. There's a 20% buffer on this note. In other words, if at maturity, if the S&P 500 is down, Barclays will absorb the first 20% of any loss. So if it's down 19%, client loses nothing. If it's down 21%, the client would be down 1%, right? So there's a buffer in there to absorb loss. So, you compare this to a PPM where there's no risk at all, no market risk at all. With this, you haven't eliminated market risk, but you've reduced it, right? You've reduced it quite dramatically by introducing a buffer. And then on the upside, Number one, it's uncapped. So, there's no cap on the growth of the S&P over this period of time. And you also have some nice leverage on this as well. So here's a way to beat the S&P 500 over the next 4 years and 9 months with downside protection and no cap at all. Right. So this is a nice, very sort of straightforward growth note. I put this other one in here just to show you that you can gain access to almost any market out there. This is a note linked to Euro stocks, right? 3 years, same buffer there, 20%. You get a little bit more leverage on this one. So the concept here is that there are ways to gain access to almost any market out there and introduce a level of protection while gaining access to that particular market. And then the last note that we're going to look at is an income note. And there's a lot of variations of income notes out there for sure, but the concept is mostly similar across all income notes, which is how can I bring enhanced levels of yield into a portfolio without introducing significantly more risk, right? So let's break down this income note, and the same pieces still apply here. You've got an underlier, you've got a term, you've got a level of protection, and then you've got your upside, or in this case, your income levels. Oftentimes you'll see with income notes, rather than it being linked to just one underlier or index or equity, typically there's more than one. So in this case, we're looking at 3 different indices. We've got NASDAQ 100, Russell 2000, and S&P 500. And you see the term there, the lesser of. So when you're looking at notes like this, you see that terminology, it's important to understand that the least performing or the worst performing index is the one that matters when looking at the overall performance of how this works. So keep that in mind as we go through this. So this is a 2-year income note. It is not callable for the first 3 months. After 3 months, it's potentially callable by Barclays, and we'll touch on that here in a minute. In terms of protection on the principal, there's a 30% barrier in place. Now, we talked a minute ago about a buffer. A barrier also offers protection on principal, but it works a little bit differently. So a barrier says if the market's down 30% or less at maturity, the client's going to get their money back, right? Just like a buffer. But unlike a buffer, if at maturity, if the worst performing index is down more than 30%, then it would be as if the client owned that index outright with no protection. They would be on the hook for the full loss at that point. So if the market's down, or the worst performing index is down 29% at maturity, client loses nothing. If it's down 31% at maturity, they're down 31%, right? So there is a difference between a buffer and a barrier. Buffer is also referred to as hard protection, where a barrier is often referred to as soft protection. So with barriers, you'll often see numbers like 30, 40, 50% barriers, so deeper protection, because of the fact that if the protection or the barrier is breached at maturity, the client's fully exposed at that point. So hopefully that's clear. We can touch more on that if you like. In terms of the upside, again, this is an income note. So it doesn't matter how much these indices may grow over the term, because the client's not going to participate in the growth. Why? They purchased an income note. What they're going to get instead is income, right? This note pays an 11.25% annual coupon, and it pays out on a monthly basis over the course of the term of this note. Now, there is a contingency built into this. The contingency says this income will be paid every month as long as the worst performing index is greater than 80% of its initial level. For me, the way that I like to understand that, it just resonates better in my brain, is every month on what's called the observation date, as long as the worst performing index isn't down more than 20% from the day that note was issued, then the coupon will be paid that month, right? So that happens every month. What that means is there could be some variability in the income, right? So keep that in mind. That's one of the potential risks when it comes to to income notes. Now let's go back to this call feature. It's non-callable for 3 months. After 3 months and every month thereafter, the note is subject to be called back by Barclays. And typically that's going to happen if the markets are up, right? It's at the issuer discretion. But if these indexes are trading in positive territory, there's a good chance that the note gets called back from Barclays. Now, if that happens, that's not a bad thing. What that means is the market's up, so the client didn't experience any loss. They got their principal back. They got their last coupon back. Money simply goes back to their custodian, at which point in time advisors will typically redeploy that into another income producing note. So that is those are really just a very high level highlight of the basic types of notes out there. Todd, I was going to ask you if you could comment for a moment on the likelihood, or not likelihood, but when does Barclays call these notes back? Under what circumstances?
It's a good question. We get that a lot. But I guess just to take a couple steps back as well. So, I mean, I know Jeremy kind of went over a lot of different things, right? A buffer versus a barrier, issuer call, observation dates. And I think getting back to my point earlier about how this market has evolved is really the implementation of these platforms. So Jeremy is taking a screenshot from Simon, which is one of the leading platforms of structured products out there. And they do all the work for you when it comes to, is something up for call? Is a coupon observation? When are my coupon observation dates? And if actually something gets called, you actually get notified that this is getting called and your money is going to be due, within 5 business days. And I think that's really the beauty of this product. And if you were to purchase a structured product, from Barnabas across amongst all the different issuers they represent, you'd simply be able to log in to Simon, see the note that you purchased, and getting back to the different pillars I talked about. So there's an education pillar, which tells you about the product. There's a marketplace pillar, which tells you what's available for purchase. And then there's a life cycling pillar, which shows you once you purchase something, it'll show you exactly how the product has performed, and then any types of like call or coupon observation dates that are coming into play. And then to circle back and as to like why an issuer would call something, I'd say, generally speaking, there's a number of different variables that go into these types of products, right? There's the actual underlier itself. There's an interest rate component. There's a volatility component and a funding component, which is dictated from our treasury. So a number of those different variables do play into our willingness to purchase the product back. From a generally speaking standpoint, if the market's up, we definitely do see things being called. I wouldn't go as far as telling a client that if the market's up, your note's going to get called from the issuer, but we've certainly seen that in a rising market. So I'll keep it there, but hopefully that answered the question.
Yeah, that's great. Thank you for that. Very insightful. Okay, so at this point, and this is a good tee up for Josh. Josh, I was going to ask you just to touch on a little bit more the technology that supports structured notes like Simon, and really the process on how to purchase a note. And keep in mind also, as you go through this, there is a question right now from a participant. The question is, what is the best practice for incorporating notes into advisory accounts? So maybe you can tie that question into your comments here.
Absolutely. Most of the people we work with are RIAs, so we work with people to put these into our advisory accounts all the time. Can you go back up to the growth versions real quickly?
Yeah, let me get there real quick.
Just the growth notes. So for example, we have, thinking of one, we have several larger RIAs who have basically used that S&P linked version. They buy 2-year and 4-year or 2.5 and 5-year notes. Is those now constitute 10 to 15% of their entire book, at least their equity exposure. So they're incorporating those across their entire book as they get new money that comes in. It's just buffering the downside and leveraging the upside. So as long as the client plans to stick with them for a while, it's just going to improve their S&P exposure. So depending on whether they're in conservative or more aggressive models, they get 10 to 15% of their portfolios in a growth note. Personally, my portfolio, I have, fee-based. I have an RIA. My advisor has me mostly in growth notes. Then when you go down to the income versions, if you could scoot down to the income.
Yeah.
These, just for a real world example, I sold a house, put the minimum down on the new house, bought an income note for the rest of it, and it pays for my mortgage insurance, to get a free mortgage, plus my HOA, my advisory account bills, my advisory fees anyway, and a few other things. So you can buy income deals are for anybody who just needs income for any reason. Some people who, for example, had a client this morning who sold a building and is used to getting 8%, went into something a little bit more conservative than this. So instead of paying 11.25, it paid 8.5, and that's going to be his income now. As an income note, a little bit more conservative than the one you're seeing on the screen now. So for any client like that, income notes are a great way to go. You can buy them through your custodian. So if you're at TD, Schwab, I guess those two will be the same soon, Fidelity, Pershing. If you have another custodian, just ask and we'll find out if these are available through that custodian. But those big four, they always are. Highly recommend having a conversation with us ahead of time about technology that Jeremy mentioned and Todd mentioned. One of the reasons these have grown so much into over $100 billion industry is because if you have a group of 20 different income notes out there of different clients, it's very hard to keep track of that. But if we have technology where you can go place the order on there, put the order into the technology, and it'll track everything for you. So you can see exactly which clients have how much of which different type of note, how much money they've made, how the note's doing, performance, all that kind of stuff, all in one place. So we have that kind of technology. You put the order in through our tech, put the order into your custodian, just like any other bond trade, and you're all set. It just drops in the client's account, shows like any other bond. So that's the short version about your custodian. If you're working through a broker dealer, then that's a conversation we can have. Whether or not the broker dealer allows it, just call the broker dealer and find out if they do structured products. You can call us if you'd like. We can always ask the same question. If they do allow structured products, then we have a conversation as to, okay, so what's their compliance process, that kind of thing, and then we can go from there. So broker dealer is a little more complicated. For RIAs, it's usually a much simpler. So if you're with a big RIA, it's worth asking them if they have a process for buying structured notes or just bonds in general, but they're available through any custodian, any of the big four custodians.
Great. Thanks, Josh. So Charles, hopefully that answered your question. I mean, bottom line is these are very, very easy to purchase compared to a lot of other products. Take annuities, for example.
And real quickly, Jeremy, I forgot to mention these. To buy something like this, we call these our calendar deals, which are just deals that are available to everybody. Each month, new deals come out. They're available for the month. You just go in your custodian and buy them, and then put them into our technology as well, so it can track it. They're $1,000 minimums, $1,000 increments. If you want to create your own structured notes, if you have a larger client and they say, I like that 11.25, but I want a deeper barrier, or I want to do a 5-year instead of 2-year, we can customize anything you need. We go work with partners like Barclays. They do a very good job of customization, and we can create any bond you want for $500,000 minimum. So if you have a larger client or even a group of clients or a group of advisors, all we need is to get to that $500,000 minimum and we can go make one for you. That's what Jeremy and I do all day long. But for these investments, just to buy off the shelf, it's just $1,000 minimum, $1,000 increments.
Yep, that's great. And again, that just highlights the ease in which these are generally purchased, especially when you compare them to some of the other products out there like annuities, which I'm certainly not poo-pooing on. We are happy to help in that arena as well. But but notes the process is generally much more streamlined and simple. So perfect. Well, that kind of brings us to the end here. We do have some time for questions if there are any. Charles, thanks for chiming in with yours. If there are no more questions, please take note of my number and my email address. Josh as well. Again, I'm local here in the Atlanta area. Josh is our head of structured notes based in the Charlotte area, but certainly we're both able and willing to answer any questions that you have on the topic. For access to Barclays, certainly that access is there. You'll just come through us to answer or to get any questions answered by Todd. So Kathy, at this point, well, before I kind of shut it down, Todd, was there anything else that you wanted to chime in at this point?
No, I think thanks for having me. Again, I'll also share my email with Kathy too if she wanted to circulate that. People can ask me direct questions, but happy to go through Barnabas as well, whatever's easier. But again, thanks for having me.
Thank you, Todd. All right, Kathy, thank you so much for organizing this. I'm going to stop share and I will hand it back over to you.
Thanks so much, Jeremy. Thank you, gentlemen. And thanks to everyone who connected with us today. Look for an event survey along with the replay and these corresponding documents to be shared with you via email. Thanks, everybody. Have a wonderful afternoon.
Thanks, everyone. Have a great week.
Thank you.
See ya.
Bye-bye.